Hi everyone, welcome back. My name is Sanjay and in this video I'm going to run through my two favorite ETFs to invest in on the Australian Stock Exchange. Now I like these ETFs because they basically give me broad exposure to some of the biggest companies in Australia and some of the biggest companies in the world through just buying two ETFs with very low fees. So I'm going to run through these index funds and point out a few key features you should look out for. They'll help you understand what's going on with these ETFs. So as always, let me just note that I'm not a financial advisor and you should definitely seek your own financial advice before you make any investment decisions. So with that being said, let's get into it. So my reasoning around these two ETFs was basically what's a great low maintenance way of having exposure to the whole world? Because how do you know which are going to be the top companies in Australia? How do you know which are going to be the top companies in the world? Well, one way is you can buy index funds that have quite broad exposure to the equities market in your various countries. Based on that, I've picked out VAS and VGS. So VAS is the Australian Share Index run by Vanguard. It's got a $6 billion market cap, which makes it pretty big in terms of Australian ETFs. It's got a management fee of 0.1%, which essentially means for every $1,000 you have invested, you'll be paying $1 in fees every year. That's pretty good. It's not the lowest, admittedly, there are a couple that are lower, but for such a broad-based ETF, that's pretty good. Now it actually tracks the top 300 companies in Australia. But here's the thing, it continuously tracks them. So it's like saying you have access to the cream of the crop all the time, forever. So as the list of top 300 companies change, like maybe banks or mining companies drop in and out of it, you'll always have exposure to that through this ETF. That's pretty handy and that's one of the biggest advantages of ETFs. Also because it's 300 companies, it essentially means you're going to be quite diversified. You'll have exposure to banks, retail companies, miners, they'll all be there, airlines even, which is not great at this time, but you know, it'll get better eventually. Now the thing to point out though is because it is VAS and it's Australian focused, there's a bit of a diversification issue from an international point of view, like you're focused in purely the Australian share market. And from an investment point of view, you want to be more diversified than purely the country you live in. So this is where the next ETF comes into play, which is VGS, which is Vanguard's International Share Index. Again, some of the headline numbers, $2.3 billion in market cap, a slightly higher management fee, so it's 0.18%. Again, that means for every $1,000 you have invested, you're paying $1.80 in fees every year. It's probably a good point to note that that's why ETFs are considered pretty attractive compared to managed funds, is it's such a low fee compared to those high managed funds where you're paying maybe 1-2%. Now, some of the key things about VGS is it covers 1,500 companies. So you have a lot of companies that you're invested in across a lot of countries as well. So it's an international ETF where it's EX Australia, meaning it buys shares in everywhere except Australia. So this is why you should buy VAS and VGS together, because then you get your Australian exposure and you get your international exposure. So some of the countries you'll be invested in if you buy shares in VGS is the USA, Japan, UK, France, Germany, they'll all be there. So it's actually quite a nice broad brush. However, something to note about VGS is the exposure is quite heavily weighted towards the US. So what does that mean? About 70% of the companies you'll be invested in through VGS will be in the United States. So even though it's international, it's kind of primarily the USA, and then the rest of the countries fall in line. The other thing to point out about VGS is it's not currency hedged, which means as the Australian dollar fluctuates up and down, which it does, against other currencies in the world, your investment may also go up and down in value, not because the underlying companies went up and down in value, but purely because the currency went up and down in value. Now, I went into a bit more detail about this in one of my other videos I did around indexed, hedged versus unhedged ETFs, which you can check out, link above. That basically explains what hedged and unhedged is, because if you're worried about currency fluctuations, you're probably better off buying a hedged ETF. And the hedged version of VGS is VGAD. It's a bit smaller, it's got a slightly higher fee because there's a bit more cost associated with Vanguard having to hedge you against the currency fluctuations, but that's also an alternative to consider. So essentially through buying VAS and VGS, you'll have exposure to over 1,800 companies and you'll be invested in both Australia and all the other countries outside of Australia, with a few exceptions obviously where basically that country doesn't have a company that appears on the index. Now a couple of things you might be thinking is, number one, what if I don't want to be so heavily invested in the United States through VGS? Well, this is where you can potentially combine VAS and VGS by buying a couple of other indexes. So one of them might be VAE, which gives you Asian exposure, because you might be saying, Sanjay, VGS is great, but I want to bump up my Asian exposure a bit. How can I do that? Well, you can go and look for ETFs specific to Asia, but Vanguard has already provided that, and that's VAE. It's got a slightly higher fee structure. I think it's about 0.4%. But through that, you'll have exposure to a whole bunch of Asian countries except Japan. There's a reason they leave Japan off, I think because it's had some tough economic years. Or you may be someone who says, hey, I want a bit more exposure to Europe. I like VGS, but I think it's a bit too USA focused. How do I get more exposure to Europe? Well, you can pick up VEQ. Again, slightly higher fee structure than what we talked about. Through that, you can basically get exposure to additional European companies on the index. So that's how you can kind of play around with the exposures. But I think broadly speaking, it helps if you start with something like VAS and VGS as your broad base. Now, the next question you're probably wondering is, well, how much of each? Should I go 10% of one, 90% of the other, 50-50? What's the breakdown? Well, this is where I'd strongly encourage you to speak to a financial advisor, get a bit more of your own research and advice on this area. Because the question you're essentially asking is, do I want to be quite heavily focused on Australia or more on countries outside of Australia? And that, to think that through, you have to consider, well, where is the world going? Where are the returns going to be? Is it going to be in a low interest rate environment like in Australia where, we've had a recession, we're struggling a bit? Or could it be in other countries outside of Australia where they've also had recession and they're struggling a bit, but are they more likely to bounce back maybe? That's something you have to consider. This whole topic around how much you should put into each is essentially this idea around portfolio composition and balancing your portfolio. I haven't done any videos on that, but if you're interested, let me know in the comment section below and I can put something together on that. If you're interested in any other videos on ETFs or investing, check out the playlist up here, and I'll see you in the next video. Bye for now.